With the rapid growth of the fintech industry, starting your own fintech company can be a great opportunity to make a significant impact in the financial sector while also achieving your own personal financial success. I made a video back in 2021 talking about how to set up a fintech startup, and the feedback and discussions that arose from that video were great. But it was evident that an update was required, especially in 2023 when we've seen the fintech investments peak and taper down, where we've observed the fintech landscape evolving, and we're seeing more traditional institutions also venturing into fintech by setting up their own fintech subsidiaries. So in this video, we're going to discuss whether starting a fintech in 2023 is still worthwhile, what are the various steps to take, and we'll do our best to go into a bit more detail. If that sounds interesting, then let's do it. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so because on this channel I speak about fintech, digital transformation, personal and career development. We've seen the fintech industry grow rapidly from a $50 billion industry in 2018, $105 billion in 2020 despite the pandemic, reaching an all-time high of $130 billion in 2021 and tapering back down to $92 billion in 2022. There have been significant investments going into the fintech sector, with investors pouring huge sums into mature startups looking to scale, and even early stage idea level fintechs that only have a proof of concept. However, the curtailing of funding that we saw in 2022, leading to the massive tech layoffs at the end of the year, was the aftermath of too much money chasing too few really good companies, which created a big bubble which is now having to be downsized. But what happens then is companies now must move away from the growth at all cost strategy and mindset and now manage costs in the direction of profitability, which overall is much better for long-term growth and sustainability. So with that said, let's answer the first question. Is setting up a fintech startup still worthwhile in 2023? Now, the simple answer to that, in my opinion, is yes. It's still worthwhile because there are still significant problems to be solved in the finance sector. Now, according to the World Bank, there still remain 1.4 billion unbanked adults globally, which represents a great opportunity for financial inclusion. Now, when it comes to meeting the demand for SME funding, there remains a gap of about $5.2 trillion, which represents the difference between the demand for financing and the availability of funding to SMEs from traditional sources such as banks and other financial institutions. Now, in Africa, that number sits between 140 to 170 billion as the SME funding gap that isn't currently being addressed by the existing players. Additionally, there remains significant gaps in the quality of the customer experience and the level of innovation that customers receive from traditional players. This represents a significant opportunity that exists for new players to not only create new and innovative solutions to bridge these gaps in funding, but to also augment the existing channels with creative, user-friendly, and more intuitive solutions that appeals more to this generation that prioritizes convenience, ease of use, and the overall customer experience. So, assuming you're convinced that fintech is still the way to go, the question then becomes, what are the steps to take in 2023 to set up a fintech startup? So let's answer that. The first thing to do is to define your idea and your business model. In the fintech industry, it's essential to have a unique value proposition that sets you apart from other companies. It's very likely that there are already others doing similar to what you are intending to do, so you need to ensure that you are not just coming in to create another Me Too startup that essentially just copies what already exists without any meaningful value proposition to the market. You always need to come back to the fundamental questions. 1, what problem are you solving? 2, who is your target market? And 3, how will you make money? So it forms part of defining your main goals and objectives for starting, and from that you will be able to identify which fintech domain or subset you're going to be playing in, be it paytech, lendtech, regtech, or any of the others. Once you're clear on your idea and business model, the next step is to conduct market research to validate your idea or assumptions. You need to research the industry and your target market, analyze your potential competitors, and identify the gaps in the market that you can fill. And beyond identifying a gap in the market, you need to establish whether there is a market in the gap. And what I mean by that is you need to be sure that the gap that you identify is enough of a problem or need for enough people that it actually makes business sense to pursue. If your niche is too small, then you might face challenges in the long term. Conducting market research can help you refine your business model and better understand your potential customers in order to properly situate your fintech idea for the startup. Now, the financial services sector, which includes both banks and fintech companies, is a heavily regulated sector. So it's crucial to be aware of the laws and regulations that apply to your territory. It's possible that you may need to submit an application for an operating license within a specific category. There may be minimum requirements like stated capital or a proof of concept. Now, nowadays, regulators are exploring fintech sandboxes, which are a great way to get your idea in front of the regulator to introduce your product or service and ensure that you fall within the regulatory confines of the industry. The industry is governed by numerous laws such as data protection regulations, KYC and consumer protection policies, and anti-money laundering laws. It's important that you devote the time to studying those laws and regulations that apply in your territories because they do differ from country to country, so you can't assume they'll be the same. If you plan to expand your fintech to multiple territories, then you should be aware of the regulation for each target market. I always advise that you don't want to invest time, effort, and resources to get your fintech started only for it to be shut down by the authorities. We've seen in many countries where fintech startups operating in the crypto space were hamstrung when the regulators woke up one day and simply banned cryptocurrencies in the territory. So keep a close eye and ear out for the regulation. After conducting market research, eyeing the regulations to make sure you are compliant, next is to begin developing your minimum viable product or MVP. An MVP is the minimum set of features that your product or service needs to offer to solve the problem you identified in your business model. Developing an MVP is a cost-effective way to test your idea and get feedback from potential customers before investing more money in the product. Also, it's much better to have an MVP ready for raising funding or attracting talent to work with you because you have something to show that isn't theoretical or abstract. Once you have an MVP, it's time to build your team. As I said previously, most organizations will tell you that their biggest asset is their people, and startups are no different. So it's important to make sure you have the right people with the right kind of skills around you. You need to hire developers, designers, marketing professionals, and other team members depending on your specific needs. I would advise that you be particularly selective of your starting team and carefully consider your modus operandi if you decide to partner with friends and family, because you don't want existing relationships to get in the way of your objectives and goals. Having the right team around you is going to determine how far you go on your journey, so make sure to hire the right people with the right skill sets to execute your business plan. With a nice team in place, you can now develop a marketing strategy to promote your product or service. Your marketing strategy should be focused on reaching your target audience and should include tactics such as content marketing, social media advertising, and influencer marketing. Now, at this point, you will need to secure funding to grow your business. There are several ways to secure funding, such as angel investors, venture capitalists, crowdfunding, and bank loans. Now, as stated before, having a minimum viable product aids your cause to raise funding because it serves as a proof of concept to potential investors. It's more important to make sure you have a solid business plan and financial projections that demonstrates the potential for growth and profitability before approaching investors or funders. Once you secure funding, the final step is to launch your product or service. However, launching is not the end of the process. You need to continually iterate and improve your product based on customer feedback to ensure its success. Now, one of the interesting developments that has recently become popular following the pandemic is that more and more banks are attempting to get into the fintech space themselves. Now, there are a few reasons for this. The most obvious is the competitive pressure from fintech startups and the threat of disruption to traditional banking services, as we've seen in the areas of payments and lending. Secondly is the bank's attempt to escape the regulatory restrictions that make it hard for traditional institutions to innovate and compete. And lastly, and quite simply, is the increasing customer demand for more digital and mobile-first banking services that are convenient, secure, and easy to use. Now, setting up a fintech subsidiary allows banks to innovate and stay competitive in a rapidly changing financial landscape while also meeting the evolving needs and preferences of their customers. There have been some successful fintech subsidiaries such as Finserv by Equity Bank in Kenya, Alat by Wima Bank in Nigeria, Marcus by Goldman Sachs, Fin by JP Morgan Chase, and Mox by Stanchart Hong Kong. However, despite the successes others have had, many bank-led fintech subsidiaries have failed to live up to their intended purpose and fulfill their mandate. So let's talk about the reasons why a fintech subsidiary of a bank can follow all the steps that we've just listed to set up a fintech startup but still fail in its agenda. Now, the first mistake that banks make is failing to create a separate culture for the startup. Now, many banks struggle to create a separate culture for their fintech subsidiaries, which defeats the purpose of trying to innovate and move quickly. Fintech startups often operate with a different mindset and culture than traditional banks, and it's important for the banks to recognize and embrace these differences. For example, most fintechs take about 5+ years to reach profitability, and only the largest and most successful ones arrive there sooner. Stripe took 6 years, Coinbase took 9 years, Revolut took 4 years, Alipay and PayPal took 3 years to achieve profitability, and they are the rare breed. Hence, if a bank takes a myopic view on profitability, then it hinders the agility and the growth trajectory of the fintech subsidiary. If the bank continues to impose its own bureaucratic processes and procedures on the startup, it will slow down progress and stifle the intended innovation. Next is not giving the fintech subsidiary enough autonomy. When the bank focuses too much on minor iterations to its existing traditional bank services, it limits the fintech's ability to pursue or explore new areas of growth and innovation. The fintech needs to be given reasonable autonomy and range to be creative and to work independently enough to succeed. Next is not attracting the right talent. Banks may struggle to attract and retain the right talent for their fintech subsidiaries. Fintech startups often require a different set of skills and mindsets than traditional banks. Banks need to adjust their recruiting and retention strategies accordingly, because the kind of talent required is also being pursued by other fintechs that offer more flexible employment packages and perks than the banks are used to, which is why that has to be taken into consideration. Next is the lack of flexibility. So banks may also struggle to be flexible enough to adapt to the changing needs of a fintech startup. Now, fintechs typically need to pivot quickly to respond to changes in the market or changing customer needs. If a bank doesn't understand this and looks at pivoting the wrong way, then the fintech subsidiary is hamstrung and can't be as nimble and as adaptable as required to succeed in the fintech space. And lastly, banks may struggle to align their goals with those of their fintech subsidiaries. Fintech startups often prioritize customer experience and may be more willing to take risks to meet the needs of their customers in order to be competitive. Fintech startups often have different metrics for measuring success than the traditional banks, and if banks don't adopt a similar mindset and adjust their expectations accordingly, it can lead to the failure of the fintech subsidiary. So in summary, banks may face several challenges when setting up fintech subsidiaries. By recognizing and addressing these challenges, banks can increase their chances of success and build strong fintech subsidiaries that can compete in the fast-paced fintech market. There's still a huge market for fintech startups in the coming years. Setting up a successful fintech requires careful planning, market research, and a dedicated team. By following these steps, you should be well on your way towards success in the competitive industry that is fintech. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment. Have an amazing week and good luck on your fintech startup journey. Cheers, guys.